to the ROI channel. It's an update. It's an end of the year update. Sorry guys, I've been a little bit sick, unfortunately, over the last few days, so I haven't been able to get this out quite when I wanted to. But I'm going to go over yearly performance for the Crassus investment portfolio, touch on the Mavericks live portfolio, and how I'm positioning for 2024. Hope you're all doing very well. Let's get into it. Of course, nothing I say is advice, so do your own due diligence. Don't be silly. Don't listen to me, and do your homework, essentially. If you are interested in having me do the work for you, you can copy the portfolio on eToro. Link will be in the description, and you just simply get the app, sign up, copy away, or do as you please. And please like and subscribe to the YouTube channel. I need to put more effort into YouTube, hoping to make that a goal for 2024 with the help of you lovely people. Link in the description to how I'm generating income, geographically dependent income via options trading and income stocks. You can check that out in the below. Currently running at around 2.8% per month return on investment. And the whole idea is a project for 2024, how I can take middle class salary amount of money, about 60 grand, and turn it into an income level of about 1% of the population using geo arbitrage. So 1% of a LATAM country would be around about $2,500 to $2,200 a month. So if you're going to do $1,200 a month in income, and you can simply take a stack of only 68 grand, then it's quite the arbitrage, I'm sure you'd agree. So you can check that out and follow me along in the journey. Link in the description. So that's what we're going to cover. 2023 wrap, performance, the importance of dollar cost averaging. Good God, the portfolio is up a lot this year, and there are people that have missed out because they didn't follow the damn instructions. And then we're going to talk 2024. So on eToro, you'll see this is 2023. Okay, so overall, finishing the year 40.5% up, which I'm very happy with. Could have done a lot better if I had to back my own judgment even a little bit more and bought more of these dips throughout the start of the year. But at the end of the day, if I can crank this out, I'm really, really happy. And I hope that you are too. If you're a copier, congratulations. What I want to point out here is the volatility, and I've said this a million times, volatility is the price that we pay for outperformance. You are not going to see every month green. You are not going to see every month, nice and smooth returns coming in. That is not the way this thing works. If we didn't have these dips, we wouldn't have the ability to outperform over time. Okay, over time is the big one. So this is why I strongly recommend anyone interested in copying the portfolio, it puts an amount of money with which they're comfortable, and that they just consistently hit the buy button week after week or month after month, whatever it is for you, so that mathematically speaking, when these dips occur, you can buy more of these good assets at a cheaper price. Not what people do. I noticed, I can see in the dashboard where if we have a down month, people leave and stop copying the portfolio. It's the precisely wrong thing to do. Okay. If you don't want to copy the portfolio, that's totally fine. Totally fine. But for God's sake, don't leave when you're down. If you trust me enough to copy the portfolio, that means that I'm buying assets, or you believe in my ability to assess assets and buy them for less than they're worth. So you want to buy them when they're cheap, not sell them when they're cheap. It's just a crazy counterintuitive thing. But I would suggest to you, if you're looking at this thing, you need to be comfortable with this type of lumpiness, because that's the way to outperform. And it just is. The volatility is the price we pay to outperform. So that's that. This is the income portfolio. So this is what I was mentioning earlier. I think I started with 65 grand, and I'm trying to return 33% annualized, but in such a way that it feeds me income. And so, yeah, so far this is the options portfolio, the Maverick Life. Started the 1st of August. So we're almost hitting 3% per month so far in terms of return. And if you're interested in learning what that's all about, there's a link in the description. So where did we get most of the performance from this year? This is interesting. Okay, so Stoneco at time of reference at least, is the highest performing asset, nearly 55% up on the year. The stock is trading at around about $18 today. There have been multiple occasions throughout the year where the thing has traded below $10. Multiple. And if you had a sold, it means that you don't know what you own. This is not a business that I'm going to hold forever, but this is an extraordinarily fast-growing business with a huge margin. They're looking to vertically integrate. Reasons that I've mentioned before on the channel, you can go and check out the videos. The Geo Group, same thing. There have been multiple times where this thing is traded below into single digits. And I think the value of just the real estate of these assets, okay, the book value, the tangible asset value of this company is worth closer to $20. So every time it drops, I don't want to sell. I want to buy. It doesn't happen. What's that makeup ad when I was a kid? It's like, it doesn't happen overnight, but it does happen. It really is true. Okay. If you can form an opinion about a business and you're correct, you just have to keep patient with that thesis. And any dip, if you is a buying opportunity if you have excess capital. And that's where the capital allocation aspect comes into it. This is the big one. Petrobras, the preferred shares. Okay. So these are the A shares. And this thing is up 45.65% on the year, not including the dividends. When you add back in the dividends, it's closer to 75%. It's the highest performing energy stock in the entire world, as far as I'm aware. And I was feeling quite lonely buying more and more of it in February and March of this year. And if you were a member of the ROI Club, I put out an exclusive video to the ROI Club in March. I remember I was in Mexico at the time, explaining why I was adding to my position and why I thought that Petrobras was the cheapest vertically integrated company on the entire planet. It's almost the case today. I think Ecopetrol is a little bit cheaper, but Petrobras has performed extremely well, and I expect that to continue. New Fortress Energy, up 32% so far. And I think that next year is really going to be the big year for New Fortress. People are only just starting to understand that they have no more CapEx left to spend. Yeah, well, it'll be interesting to check in. But I think New Fortress has another 100, maybe 200% on the upside still to come, and will pay steady dividends. PagSeguro, very similar to StoneCo. It has taken off before I could really take a position, but it has been one of the highest performing companies in the portfolio. It's only been in there for a couple of months. And Braxton Chemicals, okay, up 27%. You'll notice here as the weightings, okay, so I've gone heavily into the bigger bets. I believe that Braxton will be bought out for close to $15 a share in January. ADNOC is coming to Brazil, and I think their due diligence will be round up. It looks like Prates and Lula want this deal to go through, and so that will be a double purely on the deal arbitrage. And we'll see, of course. But in January, if I can get a 5% for the month just off one stock, then I'm very, very happy, obviously, from that double. I guess what else to point out? A lot of Brazilian companies in here, and where no one else wanted to look. And I've been pounding the bloody table on this channel and on X or Twitter about how cheap Brazilian stocks were. You have to go. You don't have to. My style is going wherever the value is. If it means going against the grain, if it means doing things differently, if it means being a little weird, so be it. I don't care, because this is why I don't care. So hopefully you guys get an understanding there. The top 5 positions by size at the moment: Petrobras, New Fortress, Ecopetrol, still paying out, or expected to pay out, close to 20% in dividends alone. I think the cheapest vertically integrated company in the world right now. Probably not as good as Petrobras quality-wise, but so damn cheap. Uranium ETF, uranium's taken off. I have started to trim this position. It was closer to 15%. I just think that there are other bargains out there that I'm going to talk about in the rest of the video. And nothing else really changes. Although we're up a lot in these positions, I expect Ecopetrol to come down to maybe a 10% yield, which would suggest a double from here. And Petrobras, I think closer to $20. So I'm not a seller at 15. I'm not a seller of New Fortress at $38. I think the thing's $100 stock, which I've mentioned on the channel months ago. And so there's that. The beauty of these is that we get paid 15% dividend, 20% dividend in Ecopetrol, and to wait it out. Wonderful, wonderful position. All I have to do is not get in my own way in the meantime, which is why it's so disheartening to see people, they leave the portfolio at precisely the wrong times. Anyway, on the left here, sector performance, and on the right, the valuation. Very interesting. So somehow, don't ask me how, the technology sector was the number one performing sector year to date. I think the technology sector is extraordinarily overvalued. I think this is purely ETF buying and sentiment driven. Valuation, it does not make sense when you look at where technology is. It's almost the most expensive. Okay, it's almost the least valuable down here in the 10th spot. Okay, you're paying next year, you're paying $34.70 for every $1 of expected free cash flow, and that's if everything goes to plan. The only thing worse than that is the utility sector. Yeah, crazy to me, and yet the thing's up 52% on the year. Energy was down in 8th spot this year, only 3.2%, which is totally fine by me because you're paying only $8 per dollar of free cash flow expected next year, where we are in the middle of an energy crisis and it's getting worse and worse and worse and worse and worse. Okay, you're only paying 1.8 times the replacement cost, and this is across the broad sector. Okay, so if you just bought the sector, that's value. If you go in and really get the niche with the Petrobras, the Ecopetrols of the world, and that's what I aim to. That's what I aim to do. Financials. This is interesting. So it looks like value. I think you've got to be really careful with the financials. I think some of the Brazilian financial tech is good. Some of the Brazilian and maybe even Colombian banks are good. I'm not a buyer of most US financials. I think that there's more risk on the balance sheet than meets the eye initially. Consumer cyclicals is up 34.8%. I'm not touching that as we're coming into a recession. Industrials is hard. I want to get more exposure to industrials. I don't see it as the right time. But we'll see. Maybe that's a mistake. All I know is that when energy is such a fat pitch, why do I really need to do much else? That's where I'm thinking. Big story of 2023 was the rise of the federal funds rate. So we're above 5% for Fed funds. Was their target between 5 and 5.5. And as of the most recent Fed conference, they're doing a pause. They're not going to do any more rate hikes, at least for now. And then apparently they're looking at doing 2 cuts next year. Wow. I mean, that's just going to bring inflation back. That is the blue line that you see here. The yellow line is the US 10-year yield. So the yield on the 10-year bond. You'll notice that it's below the Fed funds rate. And that means an inverted yield curve. The bond market is expecting, this is what this means, is that the bond market at least is pricing in these rate cuts by the Fed. It's cutting in 100 basis points worth of rate cuts. So they're going to lower the Fed interest rates by 1 percentage point over the next year. That's what the bond market is expecting. And that's generally a bearish sign. That means that the only reason why the Fed would lower rates is if we start to see recessionary or weak economic conditions. My argument would be we may well see weak economic conditions, but we're going to continue to consume energy and use real estate, which is where you're going to get into this interesting situation where you're going to lower interest rates. Let's say they do that. All that does is spur more demand for energy consumption. So that is another reason why, if it wasn't good enough that energy was so cheap, I just think the outlook for it on a fundamental basis looks really, really good. It's going to protect me more than anything from inflationary pressures that I do not believe have been solved. Okay, so oil. You guys know I'm very interested in oil. It's my largest allocation still. So if we look at the XES, that's the smaller offshore services, they've taken a run up. They're leading the pack at the end of the year. The small caps index, PSCE, has finally come up and outperformed XOP and OIH, which are 2 larger cap. E&P is XOP, and then OIH is the service sector. And XLE is the I guess, more the P than the E. So they're more producers than explorers that you'd see in XOP. All are up year to date, but it's been the smaller guys that are finally starting to lead the dance there. Yet at the same time, if you look over the year, the actual oil price, the futures price has dropped. Okay, so nearly 2% down from where we started, which is interesting. Okay, so the big story this year was uranium. I mean, you see the things up 87%. I've been talking about that for a long time on this channel. It's finally come to fruition. I'm still bullish on uranium equities, but only one really that I'm interested in buying in any great size. I've actually trimmed quite a bit of my personal holdings. In the eToro portfolio, I'm just holding the ETF, albeit in a slightly smaller allocation. Gold's up 13%. Silver's gone nowhere. I'm highly bullish on silver. It's just that I'm always bullish on silver, and it's been in deficit for like 3 years in a row. Eventually, that's got to change. So I'm trying to find ways that I can play silver. At the moment, I've only got the royalty companies and some specky options plays in my private account. Platinum is down and palladium is down, although you see this recent spike in palladium was just wicked, probably due to a lot of short coverings. I expect, if not next year on the back of rate cuts, the year after, that we start to see these metals run quite a bit. Now, recent news, shipping world. I'm becoming obsessed with the shipping world, given everything that's happening geopolitically. I think this is a real tail risk event where the rates can go out of control. That would have flow-on effects to oil prices. The Baltic Dry Index, which is only coal, wheat, corn, iron ore, those sorts of actual dry bulk that needs to be shipped around the world. You see here the massive spike in the rates. And they've since cooled off a little bit. Don't know why, because things haven't cooled off geopolitically at all. And we're up 53% on the year. I'm going to talk about that at the end. What else do we need to know? And this is a tweet I've screen grabbed from Tubby Costa's Twitter account. You're looking at the real yield here. We're getting down towards where we were in COVID and the GFC. And I'm going to read out, not all of it, but the reason why this is so serious is that, as Tubby well says, any policymaker seriously committed to fighting inflation would never announce an intention to start cutting rates before achieving their ambitious stability target. Keep in mind, this dovish communication happened on the back of a CPI still at 4%, government spending exceeding 20% of GDP, in other words, the government spending way more than they earn, risking deglobalization forces, widespread labor strikes, and an exceptionally supply-constrained commodity market. It's all just forming this perfect inflationary storm setup. And that is why my primary fear is around a loss of purchasing power, and why my allocation across all the things that I'm invested is geared toward protection from inflation more than anything else. The real yields has seen its most significant decline since the GFC and the COVID recession. This reflects, in such a highly levered economy, asset valuations reaching absurdly expensive levels. That is part of the reason why we've seen technology do what it has done, that I pointed out at the start of the video. Financial repression must always be reinstated. That is a way, this is by design. The government wants inflation so that it can reduce the real value of the debts, that it just keeps running up and up and up. Okay, I don't agree with it. Highly irresponsible. I don't really get to too much about that other than move and go to a different government perhaps, and be as smart as I can in terms of where I invest the storage units of my life's work, which is my savings. Hard assets are imperative to navigate this next market cycle. I agree. And I think that the asset is energy. That's where, if you look at previous inflation cycles, energy has been the number one outperformer. You can do well with metals and other hard assets, but it's really energy across the board that does the best. A lot of volatility I expect next year, and I think this, again, from Tavi, really explains why. So when you see the Fed tightening, right, on the red line, so when you see the red line increase, when you see from here when it starts to increase, okay, at this point where I'm drawing the line with my cursor, Move out 2 years, and you see the white line increase. The white line is the VIX, the volatility index. It's a measure of the volatility, okay, in the market. And you'll see that in roughly 2 years after the Fed starts that hiking cycle, you start to get extreme volatility events. Look at this. Okay. So right now, where the VIX is extremely quiet, the Fed has just started to embark on its most steep rate hiking cycle ever. And so I expect if we go out to 2025, 2026, we're going to see some volatility events. So maybe it's next year, maybe it's the year after. Usually, historically, as you can see here, it's about 2 years after they start hiking. So if we said that, if we said that they started hiking across sort of this year, 2023, we'd expect 2025 or thereabouts to be a really, really volatile year. Another comment on that would be the advantage of having large dividend yielding stocks, because what that does is every year, even if their price is going up and down, I get more cash given to me in the way of dividends. And if there is a big volatility event in the market and it sells off, then I have that cash there ready to buy in at lower levels. And it's been a strategy that's worked very, very well for me so far. The S&P 500 is the S&P 7, which is really the S&P 2. Okay. Look at this. This is insane. This is trading at multiples of GDP. So what the entire nation of the United States can produce, this thing is trading at such a high level compared to that. It just doesn't make any sense. Another comment would be, okay, well, what about the US economy in general? I think it really depends on the sector, but if you're looking at US stock market versus stock markets around the world, I think it's pretty straightforward to see that the US market looks very expensive generally. I think that there are some obviously good companies there. But this is another reason why I've started to look abroad in emerging markets in Latin America, because I think there's a lot of value there. And if we are going to have rate cuts by the US Fed, what's that going to do to the dollar? Well, there'll be less demand. The demand for dollars will roll over slightly. And so you'll see a drop in the dollar's value versus other currencies. More capital will flow into the likes of Brazil, for instance, where Patrick Flood and I have discussed in the past. You're getting a real yield. So you buy US government bonds. It doesn't look like the picture I showed where you have a negative real yield. You actually have a positive real yield. And so it's not unlikely that we'll start to see capital move into emerging markets if we get those rate cuts. Again, Brazilian stocks, they're breaking out. All throughout this year, I've been pounding the table on these things. They look extremely cheap in a country that looks to me at least have a very bright future. So I'm bullish Brazil. 2024, what do I expect and how am I allocating for that? Not an awful lot has changed. The big one is shipping. I am going heavily into shipping. I've had mixed experiences, but I'm starting commodities, particularly low multiple emerging market players, are still where it's at for me. Energy is around 50% of the entire portfolio. It looks to be sort of 12% LNG, 9% uranium, and 38% oil. And the metals are only about 2.75%. And of that, they're mainly royalty plays. The big one for me that's different is shipping. So I'm taking it close to 20% of the entire portfolio. I think everything that's happening with the Houthi rebels, instability in the Middle East, is leading to closures or delays going through the Suez Canal, the Strait of Hormuz, the Arabic name escapes me, that really tight strait which the Houthis control. If that happens, if there's so that's already happening, and so you're having to go around the Cape of Good Hope. That's leading to huge increases in the day rates for these charters. In addition to which, the Panama Canal, my sources tell me, is really slow in terms of its throughput. That is enough for me to be bullish on the sector, considering these things are already trading at discounts to their steel value. What would happen in an extreme event where they close the Suez Canal due to conflict, which has happened before, and the Panama Canal, for whatever reason, also closed? if that happened, it's impossible to say how high these things could go. So I'm positioned for that. A lot of them are very good dividend players, in addition to trading at less than their replacement value in a lot of cases. Real estate construction, mainly the Geo Group, that stays the same. And then the financials, again, they're the Brazilian bank slash fintech plays with extremely high margins and massive growth runways for the future. So what's the deal with shipping? Okay, it's about as cyclical as it gets. But everyone's favorite frog on Twitter, Calvin Freud, put up these two tweets, and I think he says it beautifully. So I've just screen grabbed it and put it on here. If the Hormuz and Suez are both blocked, oil could go to 1,000 to 2,000 per barrel range. I don't know. That's just an interesting point of view. Calvin's a smart guy, so I thought it was interesting. Oil went up 20x, trough to peak in 1970 to 1980 due to that closure and the Arab oil embargo. Now we have even less monetary stability. Is it really not possible, again, in the case that the Arabian Peninsula producers can't export? I don't know what's going to happen around all that, but I can see a significant upside for oil prices. And I think the thing is hanging on a knife's edge. I really do. If you look at spot freight rates, I mean, look at these things over the past decade or so for both dirty and clean tankers. This is what I'm playing for. When the things were trading at discounts to their replacement value, I think that it's a tremendous opportunity, given that the order book just isn't there anymore. So last slide for today. It's just, again, it's reinforcing this similar idea. This is for containers, which they've had a pretty ordinary 2023, but you can see as of the recent changes in global trade routes with the Houthis targeting Israeli container ships. Look at the verticality of that thing when it comes to container rates. I don't own an awful lot of containers. There is one new stock that I've put into the portfolio that you'll see. But I think that shipping in general represents value. And so I have rotated and allocated more capital towards that sector. That's it. I hope you had a wonderful 2023. Thank you very much to all of you who follow and copy the portfolio, who are subscribers to the Maverick Life, who are subscribers to the ROI Club. I really, really appreciate it. If you haven't already liked and subscribed to the YouTube channel, please, it doesn't cost you anything and it does help me. I would appreciate it. Otherwise, I wish you all the very best for 2024 and hopefully we can have another successful year. Take care.